The 90-day reserve shift. How countries are dumping dollar right now. Real-time tracker. There's a number that appears in central bank reports every quarter, a number that most people ignore because it moves slowly, incrementally, almost imperceptibly, until it doesn't. That number is the percentage of global foreign exchange reserves held in US dollars. And right now, in real time, it's falling faster than at any point since the Bretton Woods system collapsed in 1971. This isn't theory. This isn't projection. This is happening. In the last 90 days, central banks across the world have reduced their dollar holdings by amounts that would have been unthinkable 5 years ago. China, Russia, India, Brazil, Saudi Arabia. These aren't peripheral economies. These are the countries that produce your goods, supply your energy, hold your debt, and they're walking away from the dollar, not loudly, not dramatically, quietly, methodically, with the cold calculation of institutions that see something the rest of us don't yet. Because here's what nobody's telling you. When the world's reserve currency loses that status, it doesn't happen with a press conference or a treaty signing. It happens in the shadows. In swap agreements written in Mandarin, in oil contracts settled in yuan, in gold purchases that central banks report 6 months after the fact. And by the time it becomes obvious, by the time it's front-page news, it's already too late. The shift has already happened. Let me show you exactly how this works. Let's go back to 1944. World War II is still raging, but the Allied powers are already planning for what comes after. They meet at Bretton Woods, a resort in New Hampshire, and they design the post-war financial order. The system they create is elegant in its simplicity. The US dollar becomes the world's reserve currency. Every other currency pegs to the dollar. And the dollar pegs to gold at $35 per ounce. Why does everyone agree to this? Because America holds 2/3 of the world's gold reserves. Because American factories are intact while Europe and Asia are in ruins. Because the US economy is about to enter a boom that will make it larger than the rest of the world combined. The dollar isn't just backed by gold. It's backed by overwhelming economic and military dominance. For the next 27 years, this system works perfectly. If you're France and you want to buy oil from Saudi Arabia, you need dollars. If you're Japan and you want to import steel, you need dollars. If you're Brazil and you want to pay off international debts, you need dollars. Every transaction, every trade, every contract flows through the dollar. The Federal Reserve doesn't just control America's money supply. It controls the world's. But then something happens that will set the stage for everything we're seeing today. America starts spending beyond its means. The Vietnam War costs billions. The Great Society programs cost billions more. And in 1971, President Nixon faces a problem. Foreign governments watching dollars flood the world start asking for their gold. They want to exchange their dollars for the physical metal at the fixed rate of $35 per ounce. France is particularly aggressive about this. Charles de Gaulle sees what's coming and demands gold, lots of it. Nixon realizes America doesn't have enough gold to honor all these claims. So on August 15, 1971, he goes on television and announces that the United States is suspending the convertibility of dollars to gold. He calls it temporary. It's permanent. The gold standard dies that night. But here's what's crucial. The dollar doesn't collapse. It should have. The entire system was based on dollar-gold convertibility. That's gone now. Yet the dollar remains the world's reserve currency. Why? Not because of gold anymore. Because of inertia, because of oil, and because America's economy is still the largest and most dynamic on Earth. The petrodollar system emerges. Saudi Arabia and other oil producers agree to price oil in dollars. In exchange, America provides military protection. Now every country needs dollars not just for trade, but for energy. The most essential commodity on the planet can only be bought with dollars. This creates artificial demand, permanent demand. Countries have to hold dollar reserves just to keep their lights on. For 50 years, this system persists. The dollar's share of global reserves hovers between 60% and 70%. Every challenge to it fails. The euro launches in 1999. Some predict it will replace the dollar. It captures maybe 20% of reserves at its peak. Then the European debt crisis hits, and countries remember why they trusted the dollar. China's yuan barely registers. Russia tries creating alternatives after 2014 sanctions. Nobody cares. The dollar's dominance seems permanent, seems inevitable. But permanence in finance is always an illusion, and inevitability lasts only until it doesn't. Because something changed in the last 5 years. Not one thing. A cascade of things, each one small, each one defensible on its own. But together, they represent a shift that's accelerating. First, weaponization. When Russia invades Ukraine in 2022, the West responds with sanctions. Not just any sanctions, they freeze Russia's central bank reserves, $300 billion, just locked, inaccessible. Now, Russia deserved punishment for aggression. That's not the question. The question is what message this sends to every other central bank on Earth. If you're China, watching this, what do you learn? You learn that your dollar reserves aren't really yours. They're hostages. You hold them at the pleasure of Washington. And if you ever do something America disapproves of, those reserves can vanish with the stroke of a pen. If you're India, if you're Saudi Arabia, if you're Brazil, you learn the same lesson. Dollar reserves aren't an asset. They're a vulnerability. Second, inflation. The Federal Reserve printed $5 trillion between 2020 and 2022. The balance sheet exploded from $4 trillion to over $9 trillion. Now it's coming down, but the money is out there. Circulating, devaluing. If you're a central bank holding dollars, watching this money creation, you're not seeing stability. You're seeing your purchasing power erode in real time. Your reserves are melting, not quickly enough to panic, but quickly enough to notice, quickly enough to act. Third, debt. U.S. federal debt is $36 trillion and climbing. That's 123% of GDP. Interest payments alone are now over $1 trillion per year. That's more than defense spending, more than Medicare. The trajectory is unsustainable, and every finance ministry in the world knows it. When you hold another country's bonds, you're making a bet on their ability to repay. And right now, America's ability to repay is increasingly questionable. Not today, not tomorrow, but over the 10, 20, 30-year time horizon that central banks think in, the math gets ugly. Fourth, alternatives. For decades, there were no alternatives to the dollar. Now, there are. China's cross-border interbank payment system, CIPS, processed over $50 trillion in 2024. That's trillion with a T. It's not at the dollar's level yet, but 5 years ago, it barely existed. The yuan is now the fourth most used currency for international payments. Still far behind the dollar, but growing. Gold is back. Central banks bought over 1,000 tons in 2024. That's the most in decades. Why? Because gold can't be sanctioned. It can't be inflated away. It can't be frozen by a Treasury Department order. It's no one's liability. And then there are the swap lines, bilateral agreements where countries trade in their own currencies, bypassing the dollar entirely. China has swap lines with dozens of countries. Russia and India trade in rubles and rupees. Brazil and China trade in reals and yuan. Each agreement is small, but they're proliferating, and each one carves out a piece of global trade that no longer needs dollars. These 5 forces. Weaponization, inflation, debt, alternatives, and swap lines. They're not hypothetical. They're not future threats. They're here, operating, accelerating, and they're changing behavior. Let me show you the numbers. In Q1 2022, the dollar's share of global reserves was 58.9%. By Q4 2024, it's 58.4%. That doesn't sound like much, right? Half a percentage point. But that's $500 billion, half $1 trillion of central bank reserves shifted out of dollars in 3 years. And the pace is accelerating. In the last 90 days alone, identifiable dollar sales by central banks total over $100 billion, as that's faster than any quarter in the last decade. Who's selling? China is the obvious one. They held over $3 trillion in reserves at their peak. Now it's $3.2 trillion. They've reduced dollar exposure not by selling, but by diversifying new inflows. Every yuan they earn from trade doesn't automatically become dollars anymore. Some becomes gold, some stays in yuan. Some goes into euros or yen. Death by 1,000 cuts. Russia is more dramatic. Before sanctions, they held $630 billion in reserves. About 40% was in dollars. Now, essentially zero. They've shifted entirely to yuan, gold, and euros. You might say, well, Russia's a pariah state. Of course, they're dumping dollars. But that's the point. Today, it's Russia. Tomorrow, it could be anyone who crosses Washington. Every central banker on earth is looking at Russia's frozen reserves and asking, could that happen to us? India is more subtle. They're not selling dollars, but they're accumulating gold at rates not seen in decades. In 2024 alone, the Reserve Bank of India bought 75 tons of gold. For context, their total gold holdings are around 800 tons. They just increased their gold reserves by nearly 10% in 1 year. That's not portfolio rebalancing, that's strategic repositioning. Saudi Arabia is the most significant. For 50 years, Saudi Arabia has been the linchpin of the petrodollar system. They price oil in dollars. They invest their surpluses in US treasuries. They peg the rial to the dollar. It's been the most stable relationship in international finance. And it's changing. In 2023, Saudi Arabia did not renew its petrodollar agreement with the United States. That agreement, signed in 1974, wasn't a formal treaty. It was an understanding. Saudi Arabia prices oil in dollars. America provides security. The expiration was quiet. No announcements, no headlines. But it happened. And now, Saudi Arabia is exploring pricing oil in yuan for Chinese customers. They're in talks with China about opening a yuan clearinghouse in Riyadh. They're buying billions in Chinese bonds. This isn't betrayal. This is pragmatism. China buys more Saudi oil than America does now. Why shouldn't they settle in yuan? Brazil's central bank has been increasing gold holdings and reducing dollar exposure. Not aggressively, not loudly, but consistently. Their reserve composition 5 years ago was 80% dollars. Now it's 72%. France, Germany, and other European nations are pushing for strategic autonomy in finance. The European Central Bank is promoting the euro for international trade. They're building payment systems that don't require dollar clearing. Even allies are hedging. And then there's the BRICS: Brazil, Russia, India, China, South Africa. These 5 countries represent 42% of global population and 26% of global GDP. They've been meeting annually since 2009, talking about de-dollarization. For years, nothing happened. It was all talk. But at the 2023 summit in Johannesburg, they invited 6 new members: Argentina, Egypt, Ethiopia, Iran, Saudi Arabia, UAE. Now BRICS represents over half the world's population, and they're moving beyond talk. They're developing a BRICS payment system to rival SWIFT. They're exploring a BRICS currency, potentially backed by a basket of commodities including gold. They're setting up BRICS clearinghouses in Shanghai, Mumbai, and Dubai. The infrastructure for dollar alternatives is being built right now, not in theory. In practice, here's what most people miss. This isn't about replacing the dollar overnight. That's not how reserve currency transitions work. Sterling didn't lose reserve status in one dramatic moment. It bled out over decades. From 1945 to 1970, sterling's share of global reserves fell from 87% to 10%. Slowly, inexorably. Until one day, everyone looked up and realized the world ran on dollars, not pounds. The dollar is on that same trajectory, not because of one policy mistake, because the conditions that made dollar dominance inevitable no longer exist. America's share of global GDP has fallen from 40% in 1960 to 25% today. China's GDP is now comparable to America's when measured by purchasing power parity. America's trade deficit is chronic and massive. We import $800 billion more than we export every year. That means we're sending dollars overseas constantly. Those dollars pile up in foreign central banks, and those banks have to decide what to do with them. For decades, they bought treasuries, safe, liquid, denominated in the world's reserve currency. But now they're looking at 4% yields on 10-year treasuries while inflation runs higher. They're looking at $36 trillion in US debt and wondering about repayment. They're looking at frozen Russian reserves and wondering about safety. The calculation is changing. And when central banks change their behavior, the effects compound, because reserves aren't just savings, they're the foundation of the international monetary system. When a country holds dollar reserves, it's making a statement. We trust dollars. We'll use them for trade. We'll peg our currency to them. We'll settle our debts in them. But when reserves shift, that trust erodes. And trust, once lost in finance, is nearly impossible to regain. Let me show you what this looks like in practice right now in real time. The Shanghai Petroleum and Natural Gas Exchange launched yuan-denominated oil futures in 2018. Initial volume was modest. Foreign participation was low. But in 2024, volume hit record levels. Over 30% of China's oil imports are now settled in yuan, not dollars. Yuan. Saudi Arabia, Russia, Iraq, they're all accepting yuan for oil sold to China. This is the petrodollar system cracking, not breaking, not yet, but cracking, and cracks, once they appear, tend to widen. The CIPS system I mentioned earlier, it's processing more transactions every month. In 2024, average daily volume exceeded $200 billion. That's still small compared to SWIFT's $5 trillion daily. But 5 years ago, CIPS barely existed. The growth rate is exponential. And it's not just Chinese companies using it. Singapore banks use it. European corporations use it. Even some American multinationals use it for China trade because it's faster and cheaper than converting to dollars and back. The Asian Infrastructure Investment Bank, launched by China in 2016, now has 109 members. That's more than the Asian Development Bank. These members include traditional US allies, UK, Germany, France, Australia, Canada. They're not leaving the dollar system, but they're building alternatives, hedging their bets, and every alternative that gets built makes the next one easier. Network effects work in reverse too. The dollar's dominance was self-reinforcing. Everyone used it because everyone used it. But if that circle breaks, if enough countries start using alternatives, the spiral reverses. Why hold dollars if your trading partners don't need them? Why price in dollars if your customers prefer yuan? Here's the timeline of the last 90 days. This is what I mean by real-time tracking. January 2025. China's central bank reports Q4 2024 reserves. Dollar holdings down $47 billion quarter over quarter. Gold holdings up 32 tons. They frame it as portfolio diversification. It's not. It's strategic repositioning. February 2025. India announces another major gold purchase. 25 tons acquired from the IMF. That's in addition to regular purchases. When asked why, the Reserve Bank of India cites reserve adequacy and diversification. Translation: we're reducing dollar dependence. March 2025. Saudi Arabia and China announce expansion of their currency swap line from 7 billion to 15 billion. This allows direct real-yuan exchanges without dollar intermediation. The official reason is facilitating trade. The real reason is creating infrastructure for oil settlement in yuan. Also in March, Brazil and China settle a major aircraft deal entirely in local currencies. Brazil buys Chinese planes. China buys Brazilian commodities. No dollars involved in the transaction. First time for a deal of this size. April 2025. The UAE announces it will accept yuan for oil sales to China. This is significant because UAE is not just an oil exporter. Abu Dhabi is a major financial center. If they're building yuan infrastructure, every international bank operating there has to adapt. Also in April, Russia announces its trade with India hit $65 billion in 2024. Over 90% settled in rubles, rupees, and UAE dirhams. $0. 2 years ago, that trade was mostly dollar-denominated. The shift is total. These aren't predictions. These are events that have already happened, reported, verifiable, and they're accelerating. Because here's the mechanism that nobody talks about. Central bank behavior is herding behavior. If you're a mid-sized economy, say Vietnam or Malaysia, you watch what China and India do. When you see them diversifying away from dollars, you think, should we do that too? You don't want to be first. That's dangerous. But you don't want to be last either. Because if the dollar's reserve status erodes and you're still holding 90% dollars, your reserves lose value. you get caught. So there's a window, a moment when diversification shifts from radical to prudent to mandatory. And we're in that window right now. Central banks that diversify now are being cautious. Central banks that diversify next year are being prudent. Central banks that wait 5 years are going to be desperate, selling into a falling market, taking losses they can't afford. The smart money always moves first, and the smart money is moving now. Here's what makes this particularly unstable. This is a coordination problem with no coordinator. There's no central authority managing reserve currency transition, no IMF overseer ensuring smooth adjustment. Every central bank is making independent decisions based on its own interests, but those decisions affect everyone else. If you're Thailand and you see China dumping dollars, you worry. If dollars are falling, maybe you should sell too before the price drops further. But if everyone thinks that way, everyone sells. And the selling becomes self-fulfilling. It's a bank run, but for the dollar. And just like bank runs, the mathematics guarantee that someone gets hurt. Not everyone can exit at once. The markets aren't big enough. Alternative currencies can't absorb that volume instantly. So what happens? Dollar assets fall. Treasury yields spike. The dollar's exchange rate collapses. And then the feedback loops begin. Let me walk you through the cascade. Because this isn't theoretical. This is mechanical. Stage 1. Recognition. More central banks announce they're diversifying reserves. Financial media starts covering it. The narrative shifts from dollar dominance is eternal to dollar dominance is being questioned. This changes behavior. Currency traders take positions. Hedge funds bet against the dollar. Volatility increases. Stage 2. Acceleration. As the dollar weakens, holding dollars becomes a losing position. Central banks that were hesitant about diversification suddenly become aggressive. It's not about strategy anymore. It's about survival. Your reserves are denominated in a depreciating currency. Every month you wait, you lose purchasing power, so you sell. But when you sell, you're selling into a falling market. You drive the price down further, which triggers more selling. The cascade begins. Stage 3, credit crunch. Here's where it gets really dangerous. The entire global financial system runs on dollar credit. Euro-dollar markets, dollar-denominated bonds, trade finance, all of it assumes dollar stability. When the dollar becomes unstable, credit freezes. Banks can't price risk. Lenders pull back. Companies that rely on dollar loans can't refinance. Emerging markets that borrowed in dollars get crushed. Their currencies fall against the dollar, even as the dollar itself weakens against major currencies. They're trapped in a pincer. They earn in local currency, but owe in dollars. As their currency depreciates, their debt burden explodes. We saw this in 1997 during the Asian financial crisis. We saw it in 1982 during the Latin American debt crisis. It will happen again, but bigger. Because dollar-denominated debt outside the US now exceeds $15 trillion, that's double what it was in 2008. Stage 4. Policy panic. The Federal Reserve faces an impossible choice. Raise rates to defend the dollar? That crashes the US economy. We're already running massive deficits. Higher rates mean higher interest costs. The budget becomes unsustainable. Cut rates to save the economy? That accelerates dollar depreciation. Foreign holders of treasuries flee. Yields spike anyway despite rate cuts. The Fed loses control of its own bond market. This isn't hypothetical. This is the endgame of every reserve currency in history. Sterling faced it in the 1960s. They tried to defend the pound with higher rates. It destroyed their economy. Then they devalued anyway. All the pain, none of the benefit. The US is heading for the same dilemma, not today, but the setup is complete. When the cascade starts, there's no good option. Stage 5. Political chaos. When people's savings lose value, when inflation spikes because import prices surge, when unemployment rises because credit dries up, they don't blame the international monetary system. They blame their government. Approval ratings collapse. Protests erupt. Politicians look for scapegoats. Trade wars escalate. Protectionism surges. The post-war liberal economic order that's been fraying for years tears apart completely. And in chaos, dangerous leaders emerge. Populists, nationalists. Demagogues who promise simple solutions to complex problems. We've seen this movie before, 1930s. Economic crisis led to political radicalization. Democracies fell. Fascism rose. World War followed. I'm not predicting World War. But I am saying economic disorder creates political disorder, and political disorder creates security disorder. The stakes here are higher than most people realize. Now, let me show you the counter-argument, because I need you to understand both sides. The bull case for the dollar goes like this. Yes, the dollar's reserve share is declining, but it's still 58% of global reserves. That's dominant. The euro is second at 20%. Yuan is barely 3%. There's no viable alternative. Even if countries want to de-dollarize, they can't. The infrastructure doesn't exist. SWIFT processes 45 million messages per day. CIPS processes a tiny fraction of that. Building alternative systems takes decades, not years. The dollar has deep liquid capital markets. If you're a central bank with $500 billion in reserves, where else can you park that money? You need safety and liquidity. Only US Treasuries provide both at that scale. Corporate bonds, mortgage-backed securities, commercial paper, the dollar credit markets are vast. No other currency comes close, and America still has the strongest economy, the most powerful military, the most innovative companies. Google, Apple, Amazon, Microsoft, Nvidia. The future is being built in America. Why would anyone bet against that? The counter-argument is strong. I don't dismiss it. But here's why I think it's wrong, or at least incomplete. First, reserve currency transitions don't require a single replacement. Sterling's decline didn't mean the dollar replaced it one for one. It meant the world became multipolar. Multiple reserve currencies, regional spheres of influence. That's where we're heading. Not a yuan-dominated system, a fragmented system. Dollars for some trade, yuan for other trade, gold for settling imbalances. Messy, inefficient, but possible. Second, infrastructure can be built faster than people think. In 2010, if you'd said China would have its own payment system rivaling SWIFT within 15 years, people would have laughed. SWIFT took decades to build, but CPS did it in less than 10 years. Why? Because the technology is better now. Blockchain, digital currencies, fintech innovation. The barriers to entry are lower. China is launching a digital yuan. Russia has a digital ruble in testing. Europe is developing a digital euro. These aren't hypothetical. They're in pilot programs. And digital currencies change everything. You don't need correspondent banks anymore. You don't need SWIFT messages. You transfer value directly, peer-to-peer, across borders, instantly. When that technology matures, the dollar's infrastructure advantage vanishes. Third, deep capital markets are an advantage until they're not. Yes, treasuries are liquid, but liquid works both ways. You can buy easily. You can also sell easily. And if everyone tries to sell at once, liquidity disappears. We saw it in 2020 when markets froze and the Fed had to intervene with trillions. We saw it in the UK gilt crisis in 2022. Liquid markets can become illiquid instantly during stress. And there's another problem. Those deep capital markets are built on confidence. Confidence that the US will repay its debts. Confidence that the dollar will hold value. If that confidence cracks, if yields spike because foreign buyers disappear, the advantage becomes a vulnerability. Because the US has to refinance trillions in debt every year. If that refinancing becomes expensive or impossible, the system breaks. Fourth, economic and military power are important, but they're not sufficient. Britain in 1945 still had a massive military. The Royal Navy was second only to the US Navy. Britain won World War II, yet sterling lost reserve status anyway. Why? Because Britain was broke. War debt was 250% of GDP. The economy was exhausted. Military power couldn't overcome financial weakness. America isn't there yet, but the trajectory is concerning. $36 trillion in debt, $2 trillion annual deficits, and no political will to fix it. Democrats want spending. Republicans want tax cuts. Nobody wants austerity, so the debt grows. And at some point, the math overwhelms everything else. When your interest payments exceed your tax revenue, you're not a superpower anymore. You're a debtor, and debtors don't dictate terms. Fifth, innovation is real. American tech companies are extraordinary, but innovation doesn't require dollar dominance. In fact, some of the most innovative companies today are Chinese. ByteDance created TikTok. Tencent built WeChat. Alibaba pioneered mobile payments. BYD is leading electric vehicles. America doesn't have a monopoly on innovation anymore. The gap is closing. And even if American companies dominate, that doesn't mean the dollar dominates. Apple's products are priced in every currency. Google's ad revenue comes from around the world. They don't need dollar hegemony to succeed. So the counter-argument, while strong, doesn't address the core issue. The conditions that created dollar dominance are eroding. And no single factor, not capital markets, not military power, not innovation, can reverse that erosion alone. Here's what I think happens next. Not a prediction. A scenario based on the patterns I'm seeing. Over the next 12 to 24 months, we'll see more announcements. More central banks diversifying. More bilateral trade agreements bypassing the dollar. More yuan oil settlements. Each announcement will be small, defensible. We're just being prudent. But cumulatively, they'll shift perceptions. The narrative will change from "is the dollar's dominance ending" to "how fast is it ending?" That narrative shift is critical, because once the market believes dollar decline is inevitable, it becomes self-fulfilling. Traders front-run it. Investors position for it. Central banks accelerate diversification to avoid being last. Then we'll hit a trigger. I don't know what it will be. Maybe a US debt ceiling crisis that shakes confidence. Maybe a major central bank announcing a dramatic reserve shift. Maybe a geopolitical event that highlights dollar weaponization again. But something will crystallize the trend into a moment. And when that happens, volatility explodes. The dollar falls 10%, 15% in weeks. Treasury yields spike. The Fed is forced to intervene. They'll call it maintaining orderly markets. It's really defending the dollar's status. But their intervention will be limited because they're simultaneously trying to control inflation and support economic growth. They can't do everything. Something breaks. My guess? It's the Treasury market. Foreign buyers disappear. The Fed becomes the buyer of last resort, printing money to buy bonds. That solves the immediate crisis, but confirms the worst fears about dollar stability. You're debasing the currency to fund the government. That's not reserve currency behavior. That's banana republic behavior, and then we enter the messy middle. A period, could be years, where the dollar is no longer dominant, but no single currency has replaced it. Trade becomes complicated. Companies have to manage multiple currency exposures. Hedging costs rise. Some trade simply doesn't happen because the friction is too high. Global growth slows, not a crash, but a grinding deceleration as the system reorganizes around new realities. Eventually we reach a new equilibrium, probably a multipolar currency world, dollars for the Americas and some global trade, yuan for Asia and commodities, euros for Europe and Africa, gold as a neutral settlement asset. Digital currencies playing a larger role. It's not more efficient than dollar hegemony, but it's more stable than the transition period. And the world adapts. It always does. But here's the cost. During the transition, living standards fall. When your currency depreciates, imports become expensive. When trade is disrupted, supply chains break. When credit tightens, growth slows. Real people lose real wealth. Jobs disappear. Savings evaporate. This isn't abstract geopolitics. This is your retirement account, your paycheck, your ability to afford groceries. And most people won't see it coming. They'll wake up one day and wonder why everything is more expensive, why their investments are down, why the economy feels wrong, and they'll be told it's inflation or a recession or corporate greed, all of which are symptoms, not causes. The cause is a reserve currency transition that started years ago and is now accelerating beyond the point of reversal. Now let me show you what you can do. Because understanding the problem isn't enough, you need a strategy. First, diversify currency exposure. If you're 100% in dollar assets, you're making a concentrated bet that dollar dominance continues. That's a bet I wouldn't make. Consider allocating to assets denominated in other currencies. Eurobonds, Swiss franc deposits, even yuan-denominated securities if you can access them. Not because those currencies are better, but because diversification reduces risk. Second, gold. I know gold doesn't pay dividends, doesn't grow earnings, but it's no one's liability. It can't be sanctioned or inflated away. When currencies compete, gold benefits. Central banks are buying it for a reason. You should too, not all your wealth. But 5%, 10%, maybe more depending on your risk tolerance. Physical gold, not just ETFs. Because in a real crisis, you want the actual metal. Third, real assets. When currencies weaken, real assets often hold value better. Real estate in stable jurisdictions, commodities, infrastructure. Things with intrinsic utility independent of monetary policy. These aren't perfect hedges, nothing is, but they're better than holding cash in a depreciating currency. Fourth, reduce dollar-denominated debt. If you owe dollars and the dollar weakens, that's good for you. But if you owe dollars and a crisis hits and credit tightens, you might not be able to refinance. Lock in long-term rates now while they're accessible. Pay down expensive debt. Build a cushion so you're not forced to borrow during a crisis. Fifth, understand your employment exposure. If you work in finance, in import-export, in industries dependent on dollar-based trade, recognize that disruption in currency markets could impact your job. Diversify your skills. Build optionality. Make yourself valuable in multiple contexts. This isn't about quitting your job. It's about having a backup plan. Sixth, stay informed. This is a 90-day tracker for a reason. This situation is evolving rapidly. What's true today might not be true in 6 months. Follow central bank reports. Watch trade settlement data. Pay attention to currency swap agreements. The information is public, you just have to look for it. And most importantly, don't panic. Reserve currency transitions take years. This isn't a crash next month scenario. It's a slow-motion restructuring of the global financial system. You have time to adjust. But you need to start adjusting now, because the people who get hurt in these transitions are the ones who wait until it's obvious. By then, the easy moves are gone. Asset prices have already shifted. Currency positions are crowded. You're reacting instead of anticipating. Let me be clear about something. I'm not rooting for dollar decline. A messy reserve currency transition is bad for everyone, including America. It creates instability, reduces prosperity, increases geopolitical tension. I would prefer a stable international monetary system. But what I prefer is irrelevant. The question is, what's happening? And what's happening is clear if you look at the data without bias. Central banks are diversifying. Trade is shifting. Alternative systems are being built. The dollar's reserve status is eroding. Not gone. Eroding. And erosion, once it starts, is hard to stop. Think about it this way. The dollar's dominance was built over decades. The Marshall Plan, the Bretton Woods Agreement, the petrodollar system. It took 30 years to establish that dominance fully, and it persisted for another 50 years because the conditions supporting it remained. But conditions change. America's economic share is smaller, China's is larger, energy markets are shifting, technology is democratizing financial infrastructure, and most critically, the political consensus supporting globalization is fracturing. When Trump imposed tariffs, when Biden maintained them, when Europe talks about strategic autonomy, these aren't isolated events. They're symptoms of a broader shift away from the post-war consensus. And that consensus was what underpinned dollar dominance. If the world is de-globalizing, even partially, it makes sense that it would de-dollarize too, because the dollar's reserve status was always a function of American-led globalization. The two are linked. You can't have one without the other. So when I track the last 90 days, when I see China reducing dollar reserves, India buying gold, Saudi Arabia accepting yuan, Brazil settling trades in local currencies, I'm not seeing random events. I'm seeing a pattern that's repeated throughout financial history. Reserve currencies rise when their issuing nations are economically and militarily dominant and politically stable. They fall when those conditions erode. Sterling fell when Britain's economic dominance ended. The dollar is following the same path. The question isn't if anymore, it's how fast and how disruptive. And that depends on policy choices being made right now in Washington, Beijing, Brussels, and Riyadh. If US policymakers recognize the risk and take steps to restore confidence, reduce debt, rebuild trust, maybe the transition is gradual and manageable. If they don't, if they weaponize the dollar further, if they print money recklessly, if they allow debt to spiral, then the transition is rapid and chaotic. And based on the last 90 days, based on the trajectory I'm seeing, we're trending toward chaos. Not because anyone wants it, because the incentives push that way. Every country acts in its own interest. Those individual actions, reasonable on their own, combine to create instability. It's the classic collective action problem, and there's no global authority to solve it. So we stumble forward, each country hedging, each central bank diversifying, each trade deal bypassing the dollar a little more. And one day, we wake up and realize the dollar isn't the world's currency anymore. It's just America's currency. That day isn't here yet, but it's coming. The math guarantees it. The history confirms it. The data from the last 90 days accelerates it. This isn't prophecy, it's pattern recognition. And once you see it, you can't unsee it. Here's my final thought. Financial markets have a way of humbling people who are certain. I could be wrong about the timing. I could be wrong about the mechanism. But I'm not wrong about the direction. The dollar's reserve status is declining. That's not opinion. That's measurable fact. And declines, once they begin, tend to accelerate. Because the very factors that made something dominant, network effects, trust, inertia, those same factors work in reverse during decline. Everyone used the dollar because everyone used the dollar. But if enough countries stop using it, why should you? The logic flips, and when that flip happens at scale, when we cross the tipping point, the transition won't be gradual anymore. It'll be sudden, not in a day, but in months instead of years. And if you're positioned for stability when that happens, you're going to lose wealth, real wealth, the kind that changes your life. So take this seriously, not as a reason to panic, as a reason to prepare, diversify, hedge, reduce leverage, build optionality. Position for a world where the dollar is one option among many, not the only option. Because that world is coming. The last 90 days prove it. The next 90 days will accelerate it. And the 90 days after that, by then, everyone will see it. And by then, it'll be too late to position advantageously. The time to act is now, while it's still quiet, while most people aren't paying attention, while the smart money is moving, but the crowd hasn't noticed yet. That's your window. Use it. I'll see you on the other side.